Hello, good afternoon, everybody, and welcome to this afternoon's webinar. My name is Mark Peacock. I'm the MD and founder of my company called Pricemaker, and we help companies improve their pricing in order to achieve profitable growth. So what I'm going to be talking about this afternoon is on the topic of preparing your pricing plan. So we're thinking ahead to next year, which at the time of recording happens to be 2024. And I want to talk about all of the various things that you should be thinking about in terms of what you need to do and put in your business plan and your budgets when preparing for next year. So I'm going to share some hints, tips, ideas, and strategies that you can use in your business, hopefully, which should make a big difference. So our agenda today is fairly simple. I'll do a very quick introduction on my business, and then we'll get straight into the content of this afternoon's talk, which will take around 30 to 40 minutes. And at the end, I'll give you some options on what you can do as a next step in terms of both getting a copy of my book or having a follow-up one-to-one call to discuss any of your pricing challenges in person. So let's get started. Yeah, so my background is in corporate life. I was in big brand businesses like the AA and DHL for over 20 years in a variety of roles like marketing, running product teams, managing sales, and managing a business unit, a division. And in my time, in all of those roles, price always played a part, whether it's coming up with price promotions, pricing a new product, or understanding the impact of price on a P&L and the huge difference it can make at both top line and bottom line. So when I left 6 years ago now, I decided to focus on price because it seemed to me that there weren't many other people talking about price, particularly in the SME sector and more generally in B2B. So what we're trying to do is spread the word of the power of pricing and show people that there are lots of simple things you can do that make a big difference, and to help you get past the fear of making changes. We work with all sorts of clients. I was really pleased earlier this year when my company, Pricemaker, was recorded in the top 50 specialist pricing consultancy businesses in Europe, according to Vinotech. You can see our logo in the middle there. And as I said, we work with all sorts of clients in sectors like IT and digital, which includes AI, cybersecurity, online, digital applications, professional services, which includes membership organizations, consultancies, marketing agencies, training companies, and product manufacturers. And all of those clients or companies come to us with very similar reasons. It could be either that they've got a new product and it's very different to what they're used to and they don't know how to price it and they need help with setting a pricing strategy. It could be that their current pricing model is really old. You know, we've had the same model for years and it's clearly not working. Can you help us update it and find a new way to deliver growth? Or it could be internal pressures like your sales team are giving away too much discount, which is eating into your margins, or you're just worried that you're not charging the right price and you think it could be higher. So if you have any of those problems, don't worry. It's very normal, very typical. And really just starting to think a bit more carefully about your pricing is the place to start. So in terms of the content for this afternoon, I'm going to structure it in 5 sections. So number 1, why bother with planning your pricing? Number 2, how to get it right. So couple of ideas on what you can do to help improve the accuracy of your price forecasting. Number 3, implementing it. So once you've settled on your pricing plan for next year, telling your customers about your new prices. So some best practice ideas that can make it a bit easier with sharing that dreaded message about pricing. Number four, so once you're, up and running and working through the year, how do you track pricing? How do you make sure that the changes you made in the budget and your business plan are actually delivering the profit growth that you want? And then finally, finishing on number five, just stepping back a bit for a second and having a look at the bigger picture, which is about pricing strategy. How do we think about pricing strategically? And I'll share with you my framework for the 7 Ps of pricing. So let's get going. So number one, why bother with price planning? I'm sure many of you will have heard of this person, Warren Buffett, the world's most famous and successful investor, I think. And he says that he thinks that the single most important criteria that he looks for when deciding whether or not to invest in a business is what he calls its pricing power. And by that, he means those businesses that have strong pricing power are going to be able to change or raise their prices a lot more easily than those with weak pricing power. Now, he makes very few but very big investment decisions, right? So he invests in the likes of the big global giants like Apple, Amazon, Google, Facebook, all these kind of brands. So he probably knows his stuff, right? But I think what's interesting is that strong pricing power basically is a reflection of a really high quality business. If you've got strong pricing power, you've also got great branding, great products and services, great customer service, great financials, and so on, a great team, etc. But for him, it's the number one thing that he looks for when it comes to, is this a good company or not? Is it going to grow in value, and am I going to get a return on my investment? Now, the really important message to take from this is that any business can increase and improve its pricing power. It's not just reserved to the large global giants that Warren deals with. Any business can improve its pricing power. And it just takes a bit of time, a bit of effort, and a bit of thought, but it will transform the value of your business. So here's a forecast, a recent forecast from the Institute of Directors in the UK about inflation levels. Inflation in the UK has been very high, above 10% earlier this year. It's now currently hovering at about 6 to 7%. But as you can see here, if you look at the dotted line on the graph, by the end of the year, we should be below 5%. So our Prime Minister, Rishi Sunak, will have achieved at least one of his 5 priorities. But even better news, you can see that by next May, we're back down to normal inflation levels or target levels of around 2%, which, if that comes true, that's great news and very welcome for consumers and businesses alike. But obviously, between now and then, inflation is still high and your costs are still growing at somewhere between 6 to 7% on average. It could be higher depending on the industry. So what are you going to do about covering that increased cost to your business? You can't just ignore it, because if you do, the inflation level will eat away at your profit margins. Now, let's get down to basics in terms of what's important in a business. So in any business, there are only 3 key drivers of profit: price, volume, and cost. So price times volume equals your revenue, and then you deduct your costs, whether it's direct costs or overheads, and you get your net profit. So the question I have for you is, how much time do you spend on each of these 3 things? Whether it's you as a business owner, a business leader, a management team, if you take 100% of your time, how would you apportion it across each of those 3 categories? And what I find is when I do this talk around the country, particularly at the smaller end of the scale. Most businesses are spending most of their time trying to grow volumes, right? Sell more products and services, acquire more clients, increase their acquisition rates, and increase their retention rates, reduce their churn. And that's entirely understandable. And then they might spend a bit less time on managing costs and overheads, and then maybe only a small proportion of time on improving their pricing. But my argument would be that if you accept that price, volume, and cost are all equally important for when it comes to generating a profit, you should probably spend more of an even amount of time working and improving all three of them, rather than heavily weighting one heavily focusing on one, such as volume. And what you'll find, as you'll see in a second, is that price is the biggest lever you can use to increase profits, way above volume improvement or cost reduction. So if I could wave a magic wand for you and I could guarantee the outcome for your business next year, which option would you rather have? You can either have option A, and I can guarantee a 5% increase in your volumes, but at current prices, or a 5% increase in price, but at current volumes. Which would you rather have? Just think for yourself for a second and answer that question. Typically, if people haven't already heard me talk about this before, most people would probably pick option A. Yeah, grow the business. So we're growing, we're increasing market share, we're keeping our staff and our teams and our production busy. Yeah, option A, please. That'd be great. And I know I'm going to grow my profits as well. And comparatively few people might pick option B because it seems a bit stagnant, stand still on growth, the same volumes, but get a 5% increase in price doesn't really seem very exciting. But of course, as you can probably guess, the reverse is the truth. So here's an imaginary business, ABC Co Limited, with a revenue of £10 million. They sell 10,000 units of a product, and the price is £1,000 per unit. So that creates the £10 million revenue. Their unit cost per unit is £500, and they have overheads of 4 million, so their net profit is £1 million. So that's what the calculation looks like. So in the first scenario, option A, if we increase volume by 5%, volume now increases from 10,000 to 10,500, and at the same price, so our revenue is now 10.5 million. Our unit costs have gone up because we sold more volume. So if we deduct unit costs and overheads from revenue, we now get 1.25 million of net profit. So that's pretty good, right? A 5% increase in volume has led to a 25% increase in net profit. But if we do the same exercise on price, we can see a different outcome. So the sales volume stays the same, 10,000 units. We increase price by 5%, in other words, £1,050. So we have a revenue of 10.5 million, the same revenue as we would have got with the volume change. But our unit costs haven't increased because we haven't increased the volume. Overheads are the same. So that extra £500,000 on revenue all falls through to the bottom line because it's all price improvement. So we generate an increase of 50% to £1.5 million of net profit just by increasing our prices by 5%. So can you see the difference? It's very powerful. And unfortunately, most businesses don't tend to do this mental arithmetic or even do it on a spreadsheet because we just don't tend to understand the true impact of price changes. There's loads of studies that prove this. Here's one I like. which asks if we increase all of our metrics, our key metrics, which are the figures shown on the left-hand side of the screen, by 5%, what happens to profit, to EBITDA, which is the number on the right? So you can see here in this study, if revenues grow by 5%, profit grows by 12%. If cost of goods sold are reduced by 5%, profit increases by 10%. If overheads are reduced by 5%, profit increases by 5%, and so on. As business owners and business leaders, we tend to focus on those three areas: revenue growth, direct cost management, and overhead management. And that's all very sensible, but the one we miss is the one at the top: price improvement. In this example, 5% increase in price puts 22% on your bottom line. Now, of course, that figure will vary depending on the nature of your business, how your P&L is structured, and many other things. But it's fundamentally a truism that increasing your price lever is the best way to increase net profits. Okay, so that's why we should bother with planning our pricing, because it's very, very powerful. Let's think then in section 2 about how to go about it, how to think about planning and forecasting your prices for the next financial year. So here's a really, really simple example of a business and a business plan, a 3-year plan, year 1, year 2, year 3. So it could be a product line, a division, doesn't really matter. So what most businesses will do is they'll say, well, this is our current position. We've generated £1 million this year. Our unit costs were £600,000. So our gross profit before overheads is £400,000. So next year, year 1 business plan, we're going to grow revenue by 6%. Then in year 2 by 8%. And then in year 3 by 10%. We're going to assume that our costs are going to increase by 3% every year, so year on year. And then we can calculate what that means in terms of the change in net profit that we can derive. Sorry, gross profit, not net profit. So we get a 1% improvement in year 1, 3% in year 2, 4% in year 3, which is an overall increase of 8% in gross profit. But what we haven't done in this view is separate out revenue from price and volume. Remember, I said earlier, price, volume, and cost are the 3 key levers for generating profit. So let's do that, and let's see what happens. So we've got the same table, but now we've added 2 rows above the revenue line to separate out volume growth and price growth. So we're going to use the same assumptions for volume growth as on the previous slide, 6, 8, and 10%. But we're going to aim to improve our price points by 3% per year. So price goes up from 500 to 515 to 530 to 546. Then we multiply those 2 numbers together to create the revenue outcome. So you can now see that the revenue growth has gone up from 9, 11, and 13% rather than the 6, 8, and 10% we had on the previous slide. And then when you flow that through, deduct your unit costs and calculate your gross profits, you can see much higher increases in the gross profit, 9%, 11%, and 13%, which over 3 years is a 38% increase in gross profit from the current position. And the only change we made was we put in a planning assumption, a budget assumption about price improvement. So hopefully you can see why price is such a powerful element in your business mix, and you should pay attention to it in your budgeting and your forecasting. So then, well, the question then I have for you is, well, why don't we spend more time thinking about pricing, improving our pricing, planning our pricing? And I think there are typically 5 reasons that people have, whether they realize it or not. So number one is complacency. So people say to me, well, Mark, our business is growing. We're making good profits. So our pricing must be fine. We don't need to change it. Number two is inertia. We've always done our pricing like this. We're just stuck with the same old pricing model, and it's very difficult to change because it's embedded in our whole organization. Number three is difficulty. I just don't know what to do with pricing. It's very difficult. I've got to think about my customers, my costs, competitors, and it's just horrible. So I'm going to leave it to one side. Number four is ignorance. So I'm unaware of how else I could tackle my pricing. I just don't know. I just have no awareness of other ways to think about pricing. And then number five is fear. I'm scared to put my prices up because I don't want to upset my customers, and I don't know how my competitors will react. So I invite people to think, for you, which one, hand on heart, which one of those do you think is most true for you? Which one of those do you think, yeah, that's me, or that's our business? And the point of that exercise is just to get you to understand where you're at right now, so that hopefully you can accept it and start to move past it. And whatever answer you've given, and there's no right or wrong, but whichever one you've picked, I tend to think that number five, fear, is always the underlying reason. We're scared to take action on pricing because it seems risky. We don't want to upset customers. We don't want to lose future sales opportunities. So better off just to leave it alone. So fear is a really strong blocker from enabling us to take action. So let's think about how pricing can be improved. So you'll all be familiar with the graph on the right. It's called a demand curve. And the simple idea is that the higher the price, the lower the volume you sell. The lower the price, the higher the quantity you sell. And I think we all accept this as an absolute truth in business. Even if you've never done an economics degree or a business studies course, people just tend to believe that that's the absolute truth in life. The higher the price, the less you'll sell. But it's not always true. There are lots of things that affect sales volume and quantity, and price is one of those factors. And there are plenty of studies that show a small increase in price can have no impact on volume. So if you imagine your phone, doesn't matter how much you paid for it, but let's say you paid £500. And if the manufacturer was to increase that price by 2 or 3%, so it's now £510, £515, would you still buy it? Quite probably. If you think it's a great phone, a 2 to 3% increase isn't going to make any difference to your buying intention. If it was increased by 10% though, so it's now £550, you might think, oh, well, okay, that's quite a big increase. And I know that there are plenty of other phone options in the market at that price. So I might take a look around and I might consider switching. So there is a tolerance. There is an upper limit to price improvement that you can achieve without it having any impact on the bottom line. So given what I told you in section 1 about the bottom line impact of price improvements, even a small increase in price is going to make a big difference. There are ways to find out the true demand curve for your business. Here's an example of an output from a piece of pricing software that I use called PriceBeam, and it uses online pricing research surveys to test your customers, your market, about their views, about their perceptions of price and their willingness to pay. And the output it generates is the red curve is the top of we're looking for the peak, is the maximum price, in this case $8, that a customer would be willing to pay if you wanted to maximize revenue and profit. And the blue curve is the maximum price that you should charge if you wanted to maximize volume, in this case, $4. So now you know your price, the acceptable price range. It's somewhere between $4 and $8. And you can make a decision about where to pitch your prices depending on what business outcome you want, whether you're more focused on profit growth or volume growth. And it also shows price thresholds. So if you can read it on the slide, you can see at the price of $10, there's a huge price cliff. So that means if as soon as you go over $10, you'll suffer a significant drop in demand. And then we can extract the data from this to calculate price elasticity. So for any given change in price, what happens to volume? What happens to demand? So here's a simplified version of an actual client I worked with. They were a tech company. They were developing an app in the property market, and they wanted to find out what would be an appropriate fee price for the monthly subscription for their app. So you can see the blue bars show the demand curve. So starting high at the lowest price point of $3.99, 57% of people would buy at that price. And at the highest price point, £29.99, only 14% of people would buy at that price. And then we can also calculate which is the most profitable price. In this case, it would be £19.99, because when we combine that price and the take-up rate, we can calculate a net price, which is indicative of the total price potential. And these aren't difficult to do. They can be relatively inexpensive compared to any marketing budgets that you might have, but they can be tremendously powerful. And if you're raising investment, you're going to looking for funding, either from external investors or from your board. They can be very powerful evidence to put in front of those people to help justify a product, a pricing decision, or a new campaign. So that's one way to do it very scientifically. If you don't have the means or the resources, or it doesn't suit your market to do that kind of research, another great way to do it is to conduct a team exercise. So get all of your heads of department around a table, head of marketing, head of sales, head of product, head of operations, head of finance, whatever your structure looks like, your management team, and then ask each of them to silently write down a price for the product that you're considering. They need to write down 4 numbers in answer to these questions. So what would be an appropriate price for the product? What would be an expensive price? At what price would it be too expensive so that we think customers just wouldn't buy it? And at what price would we think that it's so cheap that it would put customers off because they would doubt the quality? And then you share the answers around the table and compare people's answers, and you'll get a different view from the head of sales compared to the head of marketing, compared to the head of operations. And they'll all have different insights that will be valuable in understanding the true value and the price range that you can charge. And then you can do a simple sum just to average the responses. And what we find here in this example, that for this company, if they charged anything between £180 and £290, they're probably in the acceptable price range. So they could have an entry price product at about 180, a mid-price product at about 240, maybe a premium option at 270, 280 pounds. So it's a very simple way of coming up with an internal estimate of where your prices could be pitched. Another helpful approach is scenario planning. So in this exercise, we think about a price for a product, and we think about some different prices. And then we imagine what impact do each of those prices have on volume using a best case, worst case, likely case scenario. So in this example, we have a £100 product. And in the best case, we think we'll sell 10,500 units, worst case, 9,500, likely case, somewhere in the middle, 10,000 units. We increase the price to £110. We think in the best case, we'll sell 10,000 units. Worst case, 8,500, and in the likely case, 9,000. And then if we put the price up to £120, volumes drop, but we have a best case scenario of 9,500, 7,000 and 8,000. Then you can just multiply those figures through. Price times volume equals revenue. And we can see the impact on revenue. And if we were just making a decision on this data alone, we'd probably think, well, we'll take the likely case, and maybe £110 is okay. But what you need to do is also calculate the outcome of these scenarios at a profit level. So if we assume the unit cost for this product is £60 and multiply or deduct or calculate the margin, the difference between price and cost, and then multiply it by the volume scenarios, we get the profit outcomes. And what's really interesting here is that the highest price point of £120 gives you the best profit outcome even at the lowest volumes. So £120 less £60 unit cost, multiply by any of those volume scenarios, you're still better off at £120 than you might be at 110 or £100. And you might not have realized that. You might not have appreciated that if you hadn't have done that exercise. So a simple scenario planning approach like that can be very helpful in helping you think through, see for yourself what the different impacts might be on the profit outcome of a different price. Okay, so now we've worked out our plan for next year. We've set our prices, whether it's using external research, team exercises, or scenario planning. We now need to go out to market and communicate it to our customers. So here's a couple of do's and don'ts, 5 do's and 5 don'ts on some key ways, key best practice ideas. So here are the don'ts to start with. So what you should avoid doing. So please don't just apply a flat 5% across the board price increase across all products, all customer groups. It's a very blunt and very crude approach to price improvement planning. Far better that you set it at an individual product or an individual account level. Secondly, don't wait 3 years before making a price change and then asking for a massive increase. Well, A, inflation's eaten away at your margins in that time, and B, your customers really won't like it. Number 3, when preparing your price communication language, don't use any negative language, such as, oh, we're really sorry, we've got to put prices up, we apologize, unfortunately, we've got to take this action. A price increase is a sales task. Right? You would never use negative language in any other sales conversation or communication. So you need to ban it from your dictionary and only use positive or neutral language. Number 4, if the customer objects to the price increase, don't assume that price is the problem. Take the opportunity to dig into it, find out what's really going on. Is it competitor alternatives? Is it the value of the product? And so on. It'd be really useful feedback. And then number 5, don't let fear hold you back, as we spoke about earlier. What can you do instead? Well, many of the successful businesses that I've worked with would do the following instead. So give plenty of notice, particularly in a B2B environment, so at least 30 days. Even better if you can give 2 months notice, because it shows great confidence in your pricing. Number 2, make sure you stick to a price increase at the same date every year, whether it's the 1st of January, 1st of April, 1st of September, doesn't matter, but stick to it religiously so that you train your customers to expect a price increase, even if it's a small amount. When thinking about any price improvement, make sure you start planning the activity at least 1 quarter before the date you intend to implement them. So if you're going to put your prices up on the 1st of January, you need to start now. In fact, you should have started in September. to give yourself time to do the analysis, the scenario planning, the research if you need to. Then you prepare the communications. Then you can issue communications, brief your sales teams so that you're still giving enough notice as needed. Number 4, use it as an opportunity to find out what customers really think of you. You know, don't be shy. This is golden insight and feedback that you can get from your customers. What do they actually think of you, given the prices that you're asking for the products and services you offer? And as I said earlier, do work out the impact of the price change, you know, on your financials. Are you better off just keeping 100 customers who are paying £25? Or if you increase your price to £27 and you might lose a couple, say 3, would you be better off? Well, actually you would. So there's some do's and don'ts about implementing price increases. Now, in terms of communicating price increases, here's a great example. This was an email that I received from my mobile services provider, Virgin. And what I liked about it is it has lots of examples of best practice. So firstly, they wrote to me in January at the start of the year, and they gave me over 2 months notice of the change in price, which comes into effect 1st of April. There was a clear explanation of why the price needed to change, because it was already stated in the contract that I'd signed up to. There was advice on how long the new price will last, for 12 months, giving me budget certainty and reassurance that there's going to be no other changes before that date. There's a clear set of options on what I can do if I don't want to pay that new price. I can click on the FAQs, or I can contact customer services. And there's no hard sell. It's entirely the customer's decision. Again, a very confident position to take. But what's really smart about this communication is, if you notice, it doesn't actually state the price that I'm going to be paying from the 1st of April. It just tells me the process and what's going to happen. And then it says at the end, we'll write to you again in February with the actual price. And this is a brilliant tactic. This is a 2-stage communication process. So the stage 1 is, like you see in the letter here. Here are all the reasons why our prices are going up. And then stage 2, the follow-up communication, is the actual price change. So in my situation, Virgin wrote to me a month later and says, Mark, your price is going up from £10 a month to £10.50 a month. So I've had my expectations well and truly managed, right? It's been very open, very transparent, very clear, and it's a very professional approach. And I've used that exact process with manufacturing clients and service provider clients. And it's very helpful because the initial letter, the stage 1 letter, flushes out a few of the most price sensitive clients that you might have. But you haven't actually revealed a price increase to them yet. So you can have a conversation about why and the need for a change in prices, and then you can confirm the price change to them in the following communication. So I endorse that approach for you. If you have a business that's, rather than being product-based, it's more account-based, so marketing agencies, consultancies, IT companies, those kind of things. And it's difficult to get price elasticity information on each of them, for example. Another good technique is to, if you get a list of all your clients and the annual revenue, the annual billings, if you rate each one on their willingness to pay and their strategic importance to you as a business, on a low, medium, high scale for both of those categories. So if their willingness to pay is low to medium and they have a high strategic importance, that tells us that it might be difficult to implement a price increase. If they have low strategic importance and their willingness to pay is medium, then maybe you can put up their prices a bit more aggressively. And you can put other data in, like when did they last have a price increase? what's their current profit margin, their gross profit percent, what was their longevity, and so on. And then if you plan account by account the targeted price increase you want to apply, and then you can also apply a risk of churn based on your knowledge of that account. You think, well, if we put these guys up by 7%, there's a 3% chance that they'll leave. And then you can calculate all of those numbers and assess the total impact on your revenue and your profit. And what you'll find is, more than likely, there are fewer clients that you think might leave as a result of any price increase. And the profit upside is more than worth it, even if the 4 highlighted on this page were to leave. So that's a very helpful approach as well. And then the last, I guess, piece of advice in this section is making sure you engage your sales teams in this process, and don't just give them a board level diktat to say, put your prices up or else. And this, I had exactly this experience with a client. They had a fantastic company. They already had premium prices, but their board took quite an arrogant view on the value of their products and services, and just dictated to the business, the management team and the sales teams, that they had to put their prices up next year by 10%. And there was no discussion, no leeway. It was this is the way it's got to be. And it's a very blunt and very crude way of doing price improvement, as I've hopefully explained to you. But also from the salesperson's point of view, so these are the people they've got to ring up a client and say, hi guys, next year prices are going to be 10% more expensive. So they were quite scarred by this experience, because they weren't given any support, they weren't given any justifications, they weren't given any materials or any training. And this is absolutely essential. It's one thing working out a new pricing price to go in your budget, but helping and engaging your sales teams or anybody in your business that's involved in the selling, the communication of price, customer service teams, business functional leaders, whoever. And I worked with a client recently who put a huge amount of effort into the training and engagement process with their sales teams. They had 12 regional sales directors, and they created, we conducted workshops, we created pricing tables, we had proposal templates, training decks, clear instructions and guidelines, and lots of discussions and role play, so that the sales teams could work out for themselves and really understand the new pricing model, which was a subtle change from where they'd been before. They were moving away from a day rate approach towards a more of a value-based pricing approach. So there was quite a philosophical change in price. The actual price levels weren't changing hugely. And this is as important as the question as to what the number is going to be. You know, we can spend loads of time working out the new price level, but then we have to spend an equal amount of time making sure that the implementation and the support that we provide to our teams to effectively achieve those prices is going to work. So don't make the mistake of shortcutting that process. Okay, so now we've rolled out our new prices and we're tracking through the year, and we want to know, well, we set price earlier at the start of the year. How is it performing? And there's a simple technique you can use called the price volume mix analysis. And what that does is it separates out growth in volume, price, and any change in revenue due to a change in product mix. So for example, where people are trading down to a cheaper product because the current product has gone up in price. And it's a very helpful and quite simple piece of analysis that any business can do, as long as you can separate revenue, quantity, and price, which you should be able to do. And then you can do some variance analysis. So we can see here this business had a prior year position of £1.5 million of revenue, and then in the current year they've grown to 2 million, or they're forecasting growth to 2 million. That's fantastic, right? That's 33% growth in revenue, 40% growth in volume and a slight deterioration in price improvement. So I suspect many sales leaders, many business leaders would be patting themselves on the back, saying, yeah, fantastic work, guys, that's brilliant. But you know what I'm going to say, right? We need to do this analysis at a profit level to see what the impact is on the bottom line. So if we assume that our products all have a unit cost of 50%, we can then calculate the unit cost and the gross profit margin per product, multiply that by the volumes, and we can calculate a profit outcome. And we can see, actually, although products 1 and 2 grew substantially, it was at the cost, at the expense of much reduced price and profit margin. So we've grown by 33% in revenue, but only 3% in profit terms. So, okay, I'm using a simplified example and I'm exaggerating the story to make the point. But I think what I'm trying to invite you to consider is that this price volume mix analysis is a very simple way to measure and separate out price performance from volume performance. And then you can illustrate it using a waterfall chart like you see here. So we've gone from 1.5 million up to 2 million, but we did that by reducing price performance which took 341,000 off the top line. And we increased volume to the value of 840,000. And there was no change in the product mix effect. So price volume mix is a price volume mix analysis, a very simple and effective way of measuring price performance. And then finally, once we've done all of that, and really the bigger question is, how do we set a pricing strategy for our product, for our business? So I'd like to share with you my framework, my 7P pricing strategy framework for how to think about pricing at a strategic level. So it starts with number 1, purpose. So what do we mean by that? We mean, what are your business goals? Where are you heading? If your goal is to grow significantly, do you mean in terms of volume growth or profit growth? Are you looking to exit your business and conduct a transaction in a few years? Are you looking to raise funding for a next stage of growth? Because all of those will have a bearing on your price position. Number 2 is price segmentation. So how much are your customers willing to pay? Can we conduct some of that pricing research I mentioned earlier, or do some kind of analysis to find out the acceptable price ranges that customers might have? And then we can make a better decision as to where to pitch our prices. Number 3 is positioning. How do you stand out in your market or from the competition? What makes you better or different from everybody else? What's the differential value that you bring to the party? And then how can we attach a price premium to that differential value? Number 4 is, what's your value proposition? You know, what is your product offering and what do people get for the price that they're paying? Making sure that this is all done in alignment so that when it comes to setting a pricing strategy, we can be very clear. And on the next slide, you'll see a whole bunch of different pricing strategies that you can consider. Number 6 is price communication. So communicating your price effectively, whether it's verbally, on a page, on a document, on a website, and also bringing into play some of the ideas from the psychology of pricing, which can be very powerful at this stage. And then finally, number 7, making sure we implement and track our pricing to deliver the profit growth that we want. So as I mentioned, here's a slide called 50 Pricing Strategies and Tactics. And I don't require you to read every single bullet point on this page. The purpose of the slide is just to help you appreciate that there are lots of different ways to think about pricing. Most businesses will be doing something in the left-hand column, traditional pricing, so cost plus margin pricing, competitor-based pricing, time and materials, day rates, project fees, whatever. And they might have tested some growth pricing initiatives like volume discounts, retention deals, and so on. In the middle column, you've got pricing models that are more closely linked to the monetization strategy for the business. So subscription pricing is heavily favored in online and digital services. Dynamic pricing is very common now in travel, hotels, leisure industries. But it's the two columns on the right, psychological pricing and advanced pricing, that are less well known, less familiar. But actually, there's many ideas in this section that aren't difficult to understand. And I always say to people, I bet you there's at least one in this list, at least one pricing strategy that you're not using today that will make a strong positive difference to your business. So I invite you to consider how you can move from left to right across the page and start to think about more interesting pricing approaches that could make a difference. So let me summarize everything we've covered so far. So when thinking about planning your pricing next year, please make sure you think about the power and the importance that price improvement can deliver in terms of your bottom line, your net profits. Number two, we talked about a number of ways to think about planning and forecasting pricing, whether it's using external research input, internal team exercises, or scenario analysis. Number three, we talked about the do's and don'ts of implementing a price increase. And I shared a two-stage process that you can use to soften the blow with your customers. Number four, we mentioned the price volume mix analysis and the use of waterfall charts to help you understand and really appreciate the key drivers of profit growth. And then number five, I shared with you the 7P pricing strategy framework, and also a list of over 50 pricing strategies that you can consider for your business. So there we go. I hope that's helpful. Just before we close, I just want to share a few more slides on my business. So we work with clients in all sorts of sectors, and we typically help them generate an increase in net profit as a result of better pricing, and we're currently averaging 22%. Now that will vary hugely depending on the market you're in, your products, your stage of growth, and your P&L, of course. But nonetheless, it does make a huge difference. We can help with solving your revenue growth challenges, implementing price increases, researching customer prices to understand willingness to pay, competitor benchmarking, and pricing for new products and services. There's lots that we can do to help with your pricing challenges. If you're interested to know more, everything that I've talked about today is in my book, Pricing for Success, which is available on Amazon and many other book websites. So please have a look, and you can find both the paperback version and a Kindle version. For those of you that have attended the webinar today, I'll be sending out a recording of the webinar and the slides, a PDF of my book, Pricing for Success. And if you wish to arrange a one-to-one call with me to discuss any aspect of your pricing, you'd be very welcome. And I also invite you to follow me on LinkedIn for updates, future blogs, future webinars, or go onto our website at pricemaker.co.uk, and you'll find a whole series of webinars, podcasts, and articles which share more insight and learning about the power of pricing. So there we go. Thank you all very much for listening today. I wish you the best of luck with your pricing ventures, and good luck with your business going forward. Thank you.